Going. Welcome to the Property Nomads Podcast. Today I'm delighted to be joined by Stefan Tsvetkov. Stefan is a founder of Realty Quant. That's www.realtyquant.com. It's a company that brings data-driven and quantitative techniques to the real estate industry. He's on a mission to add industry value through education, investment, technology, and analytics. Stefan's a financial engineer turned multi-family investor, analytics speaker, and live webinar host. He holds a master's degree in financial engineering from Columbia University, and during his finance career has managed around about $90 billion worth of a derivatives portfolio, jointly with other colleagues as well. Stefan, thank you very much for taking the time out of your day today. That's a hell of an introduction, and tell us a little bit more about yourself, just in case I've missed anything there.
Yeah, thanks, Rob, and pleasure to be here. Like you mentioned, I'm a financial engineer before in my prior career, and real estate investor now full-time in the US. I live in New York City, and I'm also founder of Realty Quant, like you mentioned. So we do like various like data-driven. So I have a data-driven real estate investing course, and on the education side, and also like do like market data, as well as like other like property analytics in-house, and we are also an investment company. So this is what I do.
Awesome. We're here to mainly chat macroeconomics. There's a lot of stuff going on at the moment anyway. But before we dive into that, just on the investment side and the analytics, people are obviously aware that you're based over in the USA, but data is one of those things that if it's used properly, it's going to work in pretty much any country you invest in the world. So yes, just from your experience of data-driven analytics, what do you look for as an investor when you're investing? And is there anything that you've got that can be applicable to people worldwide?
Mm-hmm. Well, that's a great question. So yes, so I would say data-driven investing is a mix of a few pieces. So one of them is automated underwriting. So that's pretty much applicable anywhere. So it's really like pulling off-market, on-market properties data and sort of trying to more precisely or approximately underwrite those properties and get a sense into their what the returns are going to be on that investment and so forth. So it really boils down to that. Now it's a little more complicated than it sounds sometimes, because for instance, like if you want to go as far as reading the images of those properties, sort of like or like reading the textual descriptions or the images, then it gets into like machine learning, natural language processing, computer vision methods, things like that are very useful in automated underwriting. Then there's also automated valuation models. So that's the things like, like kind of valuing houses algorithmically, that is very, very challenging, and so forth. But in a preliminary sense to an investor, it can be very useful because it can help you like discover like price inefficiencies, perhaps discounted properties in more illiquid markets. So this is another data-driven thing. On the commercial side, in the US, for instance, there's the value add model. I'm not sure how popular it is with you guys, where one purchases a large commercial building and sort of improves its net operating income and raises the value of that building. So that like data-driven investing is very useful to me personally. It's in terms of like modeling, for instance, rental listings data for various apartment buildings and coming up with, okay, what's going to be the value add on those buildings. So those are like other examples just on the property, like on the investor side, but it really boils down to just pulling lots of data and kind of trying to have it underwritten, modeled as much as possible, so that you kind of save time, save manual work and all that. And on the market side, it's a very interesting question, because on the market side, okay, there's like the kind of forecasting of prices, which is relatively, it's not so difficult while the trend persists. It's actually fairly high accuracy of forecasting. For example, in the US, like I had like perhaps 1.4% error predicting, like, let's say, state level appreciation in 2018, 2019, because it's a very clear trend. It's not, and now once the trend deviates, okay, then the forecasts kind of fall apart, right? And so it's that's in that sense, but really forecasting fundamentals and kind of trying to pick like the best markets based on fundamentals of population, income, housing supply. And that is really the same in every country, to your point. So real estate fundamentals, they're everywhere the same. It's everywhere: population, income, housing supply. It's really like coming down. It comes down to, are you going to understand how the economy is going to evolve in those factors and forecast prices of them. Now, another thing that my company has done that I'm very proud of is actually, so we track market valuations for real estate. So how over, under, fairly valued real estate is. Mm-hmm. Now we do it for the US. I kind of have a sense for UK from a Boomerang economics study and how it ties to what we do. But we really publish like essentially overvalued markets data for like 2,700 US counties. So we give a sense, let's say, at the current time, with perhaps the prospects of a recession, we give a sense of which markets, have more downside risk to come, after the end of the current market cycle. So this is another data-driven thing that I think is very important, that is underutilized in real estate, because I feel like people usually pick their markets based on, population and let's say job growth, all those different factors, which is okay, but there is really no downside risk management.
In terms of what I picked up from there, and again, these are key lessons that I think, regardless whether you're looking to buy your first property or real estate investment, or you've got hundreds and thousands of property, is that if you understand what's going on economically, that's useful. But knowing the area, knowing the demographics, basically doing the fundamentals and doing your homework. I mean, that lesson shouldn't be any different if you're looking to buy your first one or you've got 100 units. Is that a fair thing to say?
I think so. Yes. Yeah, definitely. Market selection, real estate fundamentals it's fairly the same, really, and it's fairly the same in. If you buy it, like, for instance, I'm Eastern European, if you buy it in Eastern Europe, or if you bought in the UK, or if you bought in the US, it just comes down to understanding those fundamentals of income and population and so forth. And, if you have a declining population region, it's roughly the same in real estate performance, whether it's in Eastern Europe or whether it's in the US. We have this with upstate New York, declining population, for instance, markets, and the price performance is perhaps quite in line with, some of the areas in Eastern Europe that experience the same demographic trend. So
that's interesting. And when you say upstate New York, to me, I'm thinking Buffalo, Rochester, those sorts of areas.
Yeah. Well, Buffalo had sort of a resurgence a little bit and kind of improved a bit this cycle, but otherwise, a lot of, I would say a lot of the Northeast in the US in general, does have like demographic challenges, let's say, that they've been for a very long time. They've been really for 70 years, it's not new, but there are like specific cities that have performed better, but now with remote work changes, then some of that is shifting as well. So there's like, shifting away from some of those cities. And so with the broad demographic problems that they have within their states now, okay, are those cities going to persist too well? I don't know. So,
Time will tell. One way to find out. I think importantly, actually, before we look at the state of what's going on at the moment, actually, before we do that, you just mentioned a couple of times demographics, and I've been trying to get this into my head as well, because with all the baby boomers, after the Second World War, etc., there's this just big massive. What I can see is this big massive curve of people are living longer. There's more old people around and about, which then potentially puts a big burden onto the financial system, because there's not necessarily enough young people to support the older people, etc. My research on this is very primitive, you're a man in the know. What are you seeing demographics wise that, globally we should be concerned about with regards to property and real estate investing?
I don't think that's a great question. I mean, that's kind of like a shift in like aging and that. And I'm not particularly concerned because that, like, at least in the US, like the way they think of that is, okay, you shift between like different asset classes, whether it's going to be senior living, whether it's going to be student housing or apartment buildings and so forth. There can be some changes, in that sense, but I don't have too big like demographic concerns at the current time myself. As far as that, I think they're in specific regions. I think it comes down to really usually not investing in regions with declining population, searching out, those better, more growing regions. In the US, those happen to be markets to the south and in the west, and then in the UK, respectively, would be in its own regions. But one thing I wanted to stress right now, because I know, for instance, so today, stock market opened in, bear market territory that, let's say, it could go into a potentially it could close there or not, at the end of the day. And there's different concerns for a recession, and gets measured differently in every country and so forth. The one thing I wanted to mention, I follow a Bloomberg economics study for overvalued real estate. Now that one, I don't have it so new. It's about a year ago actually, so it's kind of old. But the UK was in price to income ratio deviations from historical values was at 131% at the time. So there seems to be some overvaluation, just to say, in the UK, and at the same time the US was actually right around 100. And the US went overvalued subsequently. And that was tracked within my company, Realty Quant, very well. And we came up with a statement mid-2021 that the US housing market is sort of changing regime with inflation. And so, but I just want to say this thing, this comparison, it's very important to track how over or undervalued markets are at the current time, because even if they do not correct, let's say, it's not like a gloomy scenario of, okay, are they going to crash? Or I don't think real estate crashes per se. I think even if we take something like the global financial crisis, it didn't actually crash. It was in the US, it took an average of 4 years and 1 quarter to reach to the bottom. So sure, there are very big declines in the overvalued regions that were at the time, but they still took 4 years and 1 quarter. So it's an extremely slow process. Similarly, after 1990 recession, so I've done studies of the past 3 recessions, actually, 1990, 2001, and 2008. And so after 1990 recession, the broad US real estate, for instance, had no decline, but and I'm just giving it as an example of, because it's really the same fundamental analysis everywhere. There's no question about that. It's going to come down to if prices have deviated from the fundamentals of income, population, and housing supply, and if there is an economic slowdown, statistically chances are that those deviated prices, they're going to correct. And so that's what happened after every recession, at least those 3 recessions in the past 30 years or so. And so, so after 1990, US real estate was actually undervalued. In fact, it wasn't even fairly valued, it was undervalued. The majority of states were undervalued, and they experienced no decline whatsoever. But there were 9 states which were overvalued, and the economic slowdown happened. In those 9 states, the prices declined. Notably, there was, for instance, Hawaii. Hawaii was super overvalued, 48%. And it's very interesting. Since the economy recovered in a very strong way, the price corrections in those overvalued states were relatively small. They were, let's say, roughly to 1/3 of their overvaluation. And so let's say if Hawaii was 48%, and it's just a case study, then okay, it declined 14% only. But this decline took 8 years and 1 quarter to happen. So prices in Hawaii 8 years later were 14% lower. So this is the impact of investing in overvalued markets right now. So notably, on the global scene, and that's been noted by Bloomberg Economics. There is also a study by I'm not sure, like perhaps OECD related organization. And so the most overvalued real estate right now is in the scans economies. So it's not US and UK to such extent, although I suspect UK is a bit higher than the US, even though US is quickly catching up as well. But it's in the scans economies. Scans economies are Sweden, Canada, Australia, Norway, and New Zealand. So they're very different locations geographically, but they share, they're all commodity exporters, and they all have small economies, and they have independent central banks. And during the 2014-16 credit crunch, their independent central banks cut interest rates. And so scans economies are notable in the current cycle. That's by several analysts that I have seen as having very overvalued real estate. So Canada and New Zealand and Sweden and Norway, Australia are right at the top of overvalued real estate. So if somebody was to invest now there, it's not the question, are prices going to crash? I don't think, like I said, real estate crashes per se. I think real estate bleeds down to its fundamental levels, depending on how fast the recovery is. And if that recovery is very fast, like it was, or very strong, like after 1990, the correction ends up small. If that recovery is weak, like after global financial crisis, the correction ends up big, like with like to the extent of the full overvaluation, for instance. But again, whether it's smaller or bigger, correction, it's still going to be likely an underperformance. Because if we, again, like using Hawaii, just a case study to refer to, okay, they didn't correct much, okay, they're super overvalued, they correct only 14%. It's not the end of the world, but that is 14% negative performance over 8 years. In the meantime, all the other states that were undervalued experienced, let's say, 50% positive appreciation. And so there is expected relative underperformance if economic slowdown happens in overvalued markets. And so that is the key lesson, I think, like for people, whether it's in the UK, US, Canada, Australia, etc., to really track down valuations. I don't know if there are vendors who do this over there, but really to track down, okay, which are compute yourself, just take price income ratios, histories of price income ratios. How are they now, versus like historical levels? Try to get some kind of high level intuition. And that is, in my opinion, very essential. There is no, it's not like particularly negative scenario, because it really comes down to projecting the economy. It really comes down, okay, if there's a recession, how fast the economy recovers. That is, to me, the question. To me, the question is not prices. To me, it's just purely fundamentals and purely economic growth. But again, like investing in like very overvalued markets is just not already likely to underperform. And it's very important to note that those markets, be it in 1990 or global financial crisis, the markets that were overvalued at the time, at the peak, there tends to be very strong correlation between performance and if it's overvalued. That's interesting. It doesn't have to be like that. But at the end of the market cycle, the markets that did really, really well, that did the best, looks like they did a little bit too well, and then they're overvalued. And so there is very strong. So before 1990, correlation was 95%, for instance, in the US, between which, well, let's say broadly, US states did really well and were also overvalued at the time. But, okay, so definitely, in using that case study of Hawaii, definitely that was the top performer at the time. But over the next 8 years, that no longer was the case. So it's hard for people now to kind of think of this and of this potential that, okay, like those extremely booming markets, for instance, in the US, they happen to be in the South and West, like, like Florida, Texas, Arizona, and so forth, if they could actually underperform, in the future. And there aren't like such pronounced overvaluations, I would say, in the US. So it perhaps it's going to be like, in a way, a shorter term horizon than those 8 years for sure. But but still it's a consideration to take. And so I think this is like a very important fundamental metric to look at now, besides like the usual like population growth, income growth, job growth, housing supply, etc. So that's like one important thing. So Boomerang economics, they can look at like as far as on the global scene, and can also check, people can check for the scans economies. This is, I'm not sure where exactly things stand in the UK right now. That was about a year ago, but it seems to be some overvaluation. It's not as high as in those economies again. And US was even less, but US very quickly accelerated over just 1 year. So the US, I don't know what's the relationship of US and UK at the current time in terms of overvaluation, but there seems to be some overvaluation. Another thing, like I had a friend of mine, investor, like he says, okay, if something is overvalued, is it going to necessarily correct in prices? Because one might think it doesn't. But guess what? If we take GFC, in the US, about 2,700 US counties. Out of them, we take those counties at the peak of the market in, let's say, 2007, different peak in every region. And so let's say a percentage of them were overvalued. I don't remember off the top of my head. Let's say 2/3 or 70% or something like that. And then we get to the bottom of the market, which is like 4 years and 1 quarter later in 2011. And so now it's 2011, we are at the bottom of prices. At the bottom of prices, how many of those counties are overvalued? 0%. There were 11 counties only. So that's like just an example. Additionally, 1990, okay, one can say, okay, that's GFC. People think there is the concept of a crash, think that something is actually crashing. I'm not sure if that's necessarily the case, but let's say, it could be. And so from that perspective, and then if we take 1990, there is no crash at all. So US real estate prices stay the same, but regions which are overvalued, and since there is a recession, there is an economic slowdown, regions which are overvalued, those 9 states, so California notably at the time, so Oregon, besides Hawaii that I already mentioned. So how many of those that are overvalued, over 20%, 20, 30, 48% in Hawaii remain overvalued 5 years later? None. They all go to zero. They all go to zero valuation. Typically, they don't only go to zero, they go to a slightly negative valuation even. They even go slightly undervalued at the end of this kind of cycle. And so that's very interesting. So it's not, so fundamentals in real estate, they work. In the stock market, it's harder to do like a similar analysis, because in the stock market, okay, you have forecasted future earnings. Okay, it's like kind of hard to figure out what the earnings are, what should be the multiple for each and every specific company to use, like so that to figure out what the price is and so forth. And it just gets like very difficult to even gauge like how overvalued. And there are attempts, there's like different metrics in the stock market, like Tobin's Q and case, Shewar, Cape, and or just price earnings ratios and so forth. But in my experience, from my sort of like very amateur attempts to do it, it's just much more difficult. And in real estate, it's easier. It's actually in the US, like, so this kind of fundamental analysis predicted the state level declines to an 85% correlation. And then the county level declines to like a 75% correlation. So it's not hard. And again, this is not like a crystal ball. It's not about timing, or it's not about how the fundamentals recover. It's just about, okay, if something is overvalued, you can measure it. And so chances are sooner or later it's going to correct. Now, you don't know the exact timing, but sooner or later I shouldn't say correct, because not in price terms, the valuation is going to correct. And so sooner or later it's going to resolve, let's put it like this. And so this is like my observation and in 2001, so the dot-com recession, like big stock market crash in a way, but not so much for real estate. And so in the US, for instance, there were 0 states that were overvalued and so on. So after 2001, nothing happens. Just real estate continued forward. So that's interesting to note. But there was nothing that was particularly overvalued either. And so, but generally, statistically, like for me, what I'm watching now is like National Bureau of Economic Research, that's the organization here, like, is it going to declare a recession? And if it does, then okay, that's a predictor for me of the overvalued markets valuations ought to start gradually over a long period of time of 4 or 5 years to gradually go down and down and down. Now, as discussed, prices may not correct much, because usually I know, like many investors, they focus on this. Okay, perhaps prices could decline just 10%, something like that. I don't disagree with that. I think that's a reasonable, high level expectation, in some of those overvalued markets. But it's just a question of, even if they do decline 5% or 10% or something like that, it's just what's going to be the overall performance. So where do you invest? So it's kind of what is your forecasted appreciation or growth over the next years, and that.
I think what I take away from that, Stefan, first of all, thank you for going really in depth into that and explaining that. What I would say to that is people that are listening and thinking, it's very US based. The reason for that is obviously, Stefan, you're based in New York and the US market. So if people are listening to this thinking, it doesn't apply, that sort of information will apply in the UK, because when I speak to people listen to the podcast, say that they believe there's quite a bit of overvaluation at the moment here in the UK. I have no data to prove that, by the way, but that's a general feel amongst investors. So I just will point out that the US market much better. That's why the examples you've given are Hawaii and other states. So I just want to lay that to rest. The other thing that I've taken from that.
Robert, so just if I may interject, yes, but the one thing I tie to the UK is, so in that Boomerang economic study that I mentioned for overvalued real estate across countries, so their US measure at the beginning of 2021 is roughly in line with what I see. So it kind of intuitively, and so it was in agreement. So I feel like it's not super off in terms of like base, so to say. And so so that's kind of what is giving me some sense, some intuition about UK, where things stand there. So it's definitely, this stuff is applicable. This stuff is exactly the same in every single country. There is so all that people need to do is kind of really look at, the more detailed way is like income, population, and housing supply. But if one just takes price income ratios and tries to find like a deviation from historical levels, one would be able to detect the overvalued places in the UK as well.
Thank you for explaining that. And I think that the key thing to take away from this episode is that, number one, data and analytics with regards to property real estate is incredibly important anyway, and that applies no matter where you are in the world. And secondly, there's always going to be opportunity, because what I thoroughly enjoyed hearing from you was when you're talking about the 1990s GFC, that actually for all the data, there's actually still areas, even in the US, where there is still opportunity there. So they're the two key things that I would take away and say to listeners, that data is important, the analytics are important, try and understand them and use them to your advantage. And secondly, that there will always be opportunity. You've just got to know how to look for it.
Exactly, Rob. Exactly. If they invest in undervalued markets at the peak now, or let's say, I don't know if it's the peak now, but at the peak of the cycle, whenever it is, right? And then that would be just fine. That would be a fine opportunity. There could be some, economy slow down and there isn't much growth and prices stay the same. But undervalued regions, at least in the US, after the global financial crisis, the prices have crashed so much, the prices there stayed almost the same. They almost didn't decline. So it's quite interesting. So there's complete opportunity. It's just one needs to be aware where to invest, and then like conduct his projects according to that, and just not kind of avoid the overheated areas right now. But it's not probably one's intuition on what are the overheated areas probably could be correct. but it's good to look at the actual data and actually validate it, if that's the case.
Totally agree. I absolutely agree. Stefan, I think that's a wonderful place to wrap up. I think there's an awful lot of content there that people can, learn from and take away from. If people want to find out more about you or get in touch, how do people find you?
Yeah, absolutely. So my website, realtyquant.com. Also, I have a YouTube channel, Finance Meets Real Estate on YouTube.
Perfect. We'll put the links to that in the show notes, as we always do. And just a massive thank you again, Stefan, for your insight. I've learned a lot from the last half an hour, and I'm sure people listening have learned a lot as well. And, look forward to maybe having you on again.
Thank you as well.